Recipes for technical trading success in Cook's Kitchen.
Have you noticed that the trade war has taken a little turn here and made the market semi-nervous? And by that, I mean, of course, the semiconductors. Or you could say, White House loose lips sink chips. Pardon the puns. Let's get right to it. What am I talking about? I'm talking about companies like Lam Research, Applied Materials, which are both semi-equipment makers. They provide the picks and shovels, so to speak, to make those wafers. And then NVIDIA, stand out in artificial intelligence, Micron in memory, and Alibaba? What do they have to do with the trade war jitters and White House loose lips sinking the chips? We're going to dive into what's been going on the last 2 weeks as the trade war gets more specific in attacking China on intellectual property. All right, so on June 15th, here was a commentary I wrote for my Taser Trader subscribers, talking about the White House America First agenda and how the chips were really starting to sell off, even though there was nothing specific in any of the White House commentary directed towards semiconductors. What were we hearing? Well, what were we seeing? We were seeing that the stocks were selling off. And that's because the global supply chains for semiconductor manufacturing and equipment are probably some of the most complicated. So tariffs would definitely throw a wrench in the works. And look at this quote at the bottom. This is from the Semiconductor Industry Association. Tariffs on semiconductors would harm, not help, U.S. semiconductor companies, their workers, and American consumers. All right, but this is about more than tariffs on semiconductors, because what the White House is really going after is the transfer of technology. So let's go a little deeper into the story as we learn more and as it evolves. This was a story, part of a story from the Wall Street Journal that came out that same Friday, June 15th. And I just titled it, Stopping Chinese Tech Theft at Any Cost. That's not what they titled it, but some of the things that they talked about was, what is the White House trying to accomplish? And they're trying to accomplish the theft of American technology. So, what they call a transfer of technology. So let's look at where this comes from. It comes from, we know what China's goals are. In 2015, they announced a 10-year plan called Made in China 2025. And some of their primary goals were to increase the domestic content of core materials to 40% by 2020 and 70% by 2025. In other words, sort of move up the value chain and have China manufacturing more of its own higher-end goods, whether that's computers, cars, you name it. They wanted to make their own stuff instead of importing semiconductors from, Intel or Korea. So at the time, the Council on Foreign Relations said this is a real existential threat to U.S. technological leadership that China wanted to advance on the technology global stage. All right, so let's get specifically into how this impacts a couple of companies that I like and frequently own and trade, and that's Lam Research and Applied Materials. They make semiconductor wafer fabrication equipment, WFE for short. So who are the big customers for WFE? Intel needs to buy the equipment to make chips, Samsung obviously, and another company called Taiwan Semiconductor Manufacturing, which is sort of a contract manufacturer for many different types of chips, whether they're mobile, for Apple, or otherwise. A quote here from Dan Gallagher, but Chinese chip makers are starting to write some large checks as well. I'll get to some more from Dan Gallagher from the Wall Street Journal in a minute. Here's what the CFO of Applied Materials said just last month after their conference call. China is emerging as a spender. Their strategic intent is clear, and the financial resources they have are also clear. So this is what the White House knows. This is what they're trying to combat. That the ability for China to buy our semi-equipment manufacturing, the WFE, wafer fabrication equipment, and then steal the technology, build it themselves, and create their own semiconductor empire. All right, here was the article this Monday from Dan Gallagher at Dow Jones. Chip equipment makers in crosshairs of trade war. I include a couple paragraphs here from Dan because he starts out kind of fun the way I like to write. Wars are generally good for arms dealers, but may not be so for semiconductors. And I'll just read the yellow here. China accounted for about 14% of trailing 12-month revenue for the equipment makers, on average, for the eight semiconductor tool companies that an analyst from Cowen covers. Okay. Dan Gallagher concludes, that means the loss of future sales could be significantly more than 14%. War is hell. And we've seen this in many of these equipment maker chip stocks. I own Lam Research, and the stock has fallen over 10% from above 200 to, actually it fell 15% down to 170. So, and Applied Materials as well. And you've even seen NVIDIA, which is just a maker of high-end graphical processing units, and Micron, who says their memory business is good. You've even seen those stocks sell off. All right. Then this morning, okay, so this is this morning. We've had all this back and forth rhetoric, right? So I say loose lips at the White House, and to make the clever pun of loose lips sink chips, but we've had this back and forth rhetoric. From Monday, we hear one story that the U.S. is ready to implement sort of a blockade against China's ability to buy, not only come here and buy our companies, but what equipment they buy. So then on Monday night, Peter Navarro was heard in the press sort of walking back that. No, this is not, it was just a story in the Wall Street Journal. We've said nothing about this. We have no plans to target China specifically. Even the Treasury Secretary Mnuchin said that. So then here is this morning, White House. Existing laws to restrict Chinese investment in the U.S. are the best approach to protect technology. The Trump administration has decided to rely on existing laws to restrict Chinese investment in U.S. companies and dropping the consideration of alternative approaches. Okay, so what does this mean? It means no new measures to create a blockade against Chinese investment in companies or in equipment. They'll find a way to use existing laws. So that sort of a sigh of relief that they're not going to come up with new measures, but they still are very focused on preventing China from buying our technology and what the White House calls stealing our technology. All right. What's going on with the Chinese stock market during all of this? Well, you can see this is a one-year chart of the Shanghai Stock Exchange Composite, and well below its 50 and 200-day moving averages, which had their death cross back in March. But just in the past 2 weeks, in this time period I've been talking about, the index has dropped, another 7% or more, and almost 10%. And actually, so this is from the close on Tuesday the 26th, but for their Wednesday, the 27th, the index dropped another 1% to like 28.10, I think. So that's a look at the Chinese stock market not faring well during this. But what about Alibaba? Why should Alibaba be caught up in this? And here's my thesis, why Alibaba shouldn't be caught up in this. Because they're more like Amazon. And so specific restrictions against anything that Alibaba is doing are probably not coming and wouldn't make sense. And Alibaba, I'm not sure the exact percentage of revenues that come just internally from China, but it's pretty high. So they're building a business based on the Chinese consumer. And yes, they want American businesses to be able to sell on their platform to Chinese consumers if they want to. So, maybe that's part of it. Maybe something's going to happen specifically there with Alibaba's plans to let American businesses use Alibaba as the gateway to sell to the largest middle class in the world. We're talking about a middle class of over, arguably 500 to 600 million strong that is just continuing to grow. And we're going to look closer at that. I did in May, I did a deeper dive on Alibaba after their earnings report. And this was a special presentation I did for Zacks Ultimate members. On the left is the column specifically about Alibaba, a great quarter and outlook. And on the right is what are they selling into? Well, they're selling into the biggest middle class globally. So for the great quarter, I looked at great top line growth. Taobao and Tmall are worth $8 billion in revenues. Alibaba's cloud business doubled, and their digital revenues segment grew 34%. And at the very bottom there about Alibaba, they invested $9.5 billion to buy a company called L.me, which is a online grocery delivery. Okay? So now over to the right column about what markets they're going into. In 2017, retail sales in China were worth $5.9 trillion. Their online sales in China are growing to over $1 trillion, $1.1 trillion. And Alibaba's on pace to have a gross merchandise value of $1 trillion by 2020. And Alibaba is tech and media just like Amazon. And they're going back to brick and mortar with this investment in the grocery business. So obviously you can stop this the video, take a look at this slide in more detail, and understand what Alibaba is doing that makes it the Amazon of China and the market opportunity it has with the largest middle class in the world. Let me show you what that middle class looks like in terms of consumer spending. This is, I'm not sure where I got this chart, but it is based on data from the National Bureau of Statistics of China, and it's annual disposable income per capita. So you see the Chinese yuan on the y-axis and how disposable income has grown in the past 20 years. It's getting pretty vertical, right? And, think of the exchange rate. We're not talking about, it's not the U.S. middle class, because if we apply the exchange rate of now it's up to 6.6. You can see these are smaller dollars, but it's all about the growth trajectory of the Chinese consumer. And this is the market that Alibaba is speaking to, communicating with, and engaging with to be able to sell whatever. Now, I showed you that $9.5 billion acquisition of that online grocer. They also have another store, which is sort of the Whole Foods of China, called, oh boy, if I can pronounce it again. Hema, I believe. We spell it in English, H-E-M-A, but I'm not sure how you pronounce it in Chinese. Anyway, it's a totally digital shopping experience. And what I mean by that is your phone can connect with every product and service in the store. So, you can do everything from do all your shopping on your phone when you're not even in the store and have it and pay for it and have it delivered. Or you can be in the store engaging with products with your mobile device, get information, get price comparisons, buy it right there, and then have the order waiting for you. So this is the sort of advanced shopping experience that Alibaba is trying to create, going back to brick and mortar, just like Amazon buying Whole Foods. So, Jack Ma, the CEO of Alibaba, he knows what he's doing. He's very visionary. And my colleague Tracy Reinig just did a video presentation this week about visionary CEOs, and she picked him as one of her top 5, along with, I think, Elon Musk of Tesla, the guy from Restoration Hardware, Jensen Huang of NVIDIA, some of my favorite companies. But the Chinese opportunity is huge, and that's why I think you want to own Alibaba as a gateway to those consumers. All right, thanks for joining me in the kitchen.